Hey everybody, it's Jimmy and Bill. Bill, I've been watching these videos. Like, I watch a lot of YouTube, read a lot of articles, trying to figure out topics to talk about, And lately it's been popping up more and more. This is 2008 all over again. The crash is coming. Here's, we're in trouble. Sell, panic, And I know, when you have panic videos or panic articles, people are more interested in those.
Right.
Okay. So I pulled out some stuff. I did some research in this, and what we're talking about is in 2008 housing crash, in 2025, share some similar, stuff together.
I would agree with that, yeah.
Okay. But there's also key differences. So we're going to break it down by what's similar and what the difference is, and can it happen again? So stay till the end, because we're going to talk about if it can happen again, the differences, and what's similar, okay? So let's start, okay? Rising interest rates. In 2008, rising interest rate made an adjustable rate mortgage arm more affordable, leading to mass foreclosures. Remember, the rates were low.
Yep.
And then people started getting arms, and then the arms were adjusting, and then people couldn't afford their mortgages anymore.
Correct.
Okay? In 2025, mortgage rates have climbed again, making homes less affordable, slowing down the market. At the time of this, we're doing this video, and you guys can comment below, but we know that some rates are dropping. Okay, so
right.
Some mortgage rates are dropping, but overall, the day of the 3% and 4% rates are gone.
Right. There's a big difference between I can't wait till the rates get back to 3 and 4%, and then we're getting into 6.5, 6, 7, 5. Those are good rates that we have now. Just look at historical rates prior to, 2019. What were the rates? We were in the 5.5 to 6.5%.
Yeah, you can't look at the unicorn years. I mean, those times. That's why I call them unicorn years.
That's why they're called unicorn years.
I mean, we had COVID. We had
outside of another black swan event, we're not going to go down to that. And then if we have another event, no matter what it is, we've got bigger problems than buying houses and the interest rates.
Yeah. So let's go on to the next one. In the meantime, do me a favor, give this video a thumbs up, share it, and, subscribe. It really helps out the channel. All right, Bill. High home prices. In 2006, 2007, home prices skyrocketed due to easy credit and speculative investment. In 2024 to 2025, home prices are at record high due to limited inventory, investors, and high demand. I know the high demand is dropping a little bit now, but those are similar. 2006, 2007, prices did go up quite a bit because it was anybody with a heartbeat could get a mortgage.
And that's the key difference that we're talking about here. Anybody, they had no doc loans, meaning they were stated income.
Stated incomes, stated assets.
Oh, I have $600,000 in the bank. Oh, okay, here's your loan. Go buy your $700,000 house.
And if anybody says, well, how do you know that, Jimmy? I was a mortgage broker during those times.
Well, that's just a fact. That's documented. It's a fact. It doesn't matter.
Yeah.
I know you were a mortgage. You were one of those evil mortgage brokers. Jimmy didn't do that stuff.
I didn't do that stuff.
But the point is, that's what we had during those times, and it's different now. Trying to get a loan now is extremely difficult. And then, yes, I know you're probably able to say, hey, I think there was I think that there's similarities, and look at this loan and look at this program like an ARM as an example, but ARMs have existed for a long time. And there's regulations in place now that prevent the issues that we had in the past, especially predatory lending.
Yeah, all right, this one is true, similar. Declining home affordability. In both cases, wages haven't kept up with housing costs, making home ownership increasingly out of reach for many. That's true then?
It's true now.
That's a true statement. That's similar.
Yeah, that's similar. I don't think that means that we're going to have an economic real estate crash.
Okay, this is a big one, okay? Check this one out. Growing consumer debt. In 2008, subprime mortgages were a major, major problem getting a loan, because anybody could stated income, stated asset. Oh, what do you need me to make? $150,000? Do you make $150,000?
Cool,
Sure.
I make $150,000.
Okay, you get the loan. But in 2025, people are struggling with credit card debt, student loans, and rising cost of living, which impact the housing market. It's true.
That is true.
Okay, believe it or not, we have more debt now than we did. Back then, it was the subprime market. Anybody could get a mortgage. and a lot of them were taking arms, you know,
Right.
and it was a disaster. But now we have $1 trillion in debt, credit card debt. I think it was, Angie said it was $1.5 trillion right now. I mean, people just,
Well, I mean, look at the economy right now as a whole. You know, I don't think, I mean, it's sad. You've got a lot of people have to put groceries on a credit card, you know, and I know that the election's over, but things don't change overnight. Like we've said on countless videos, those things don't change overnight. It's going to take time for the economy to heal. We're getting there, and wages can't just magically increase because then the cost of goods is going to increase. Think about that for a second. You know, if you just artificially push up, you know, minimum wage, that's going to trickle up, and then it's also going to increase the cost of goods because they have to pay the workers to get the goods here. So it has to be natural. And I said it time and time again, just like with interest rates, we don't want a rapid spike and a rapid drop. We want a nice, slow, steady climb with little ripples on the water. Like think of it as a nice day out on the boat.
yeah, of course. That was the other one that was, you just hit the nail. Economic uncertainty. In 2008, crash followed a Great Recession. Okay, in 2025, there are recession fears due to inflation, layoffs, tech, and other industries, and geopolitical instabilities.
Right. Those are all real things.
Those are real things. And, you know, in my opinion, like I said last year before we knew who was going to be president, I don't care who was going to be president. Okay, whether it was Biden, whoever, it doesn't matter. Trump, I think the first 6 months were going to be tough. And in my opinion, we are still heading for a recession. Okay, and
They were talking about that. I know Trump said something about that recently, last couple of days, you know, that it's not off the table and there are concerns. And I mean, the warning signs are there, but, you know, especially when we change the definition of a recession.
yeah, because technically we had a recession,
We
but
had a
they're like,
recession.
well, that doesn't really
Yeah,
count.
it doesn't count because we're going to change the definition
You know,
and we're going to go
negative GDP, you know, that doesn't matter.
Yeah, we're going to redefine this real quick. So, you know, Webster Dictionary, let's switch that up.
All right, let's talk about differences between 2008 and 2025,
Okay.
because we went through the similarities, okay? Stronger lending standards. In 2008, banks gave out risky loans, subprime mortgages,
Yeah.
with little to no income verification. Today's lending standards are much stricter, reducing the risk of mass defaults. True or not true?
Oh, that's 100% true.
100% true.
It's very difficult to get a loan now. It's not impossible, but the you know, the amount of money, like I'm working with a buyer right now, and he's very well qualified, but he has had to produce his statements over and over and over again, because if one gets just I think it's 3 months old, then he has to resubmit the newest one. You know, things change. It's the new tax year that we've rolled over into 25. So now it's like, oh, well, now I need your new tax return. They're not going to go off
yeah,
of
in
last
2008,
year's.
that wouldn't have happened.
Yeah, nobody cared back then. Here you go. You're good to go.
Here's another difference, okay? True or not true? Homeowner equity is high. In 2008, people had little to no equity in their homes, so foreclosures happened fast. In 2025, most homeowners have significant equity, making foreclosure wave less likely.
Exactly. That's 100% true. And if I recall correctly, I don't remember the exact number, but it was in the 40% and up of Americans don't have a mortgage, period.
40%?
40% don't have a mortgage, period.
Wow.
And I think it's a little higher, but and then the amount that's mortgaged is very low. So there's a lot of equity in people's houses. So what happens is if you have equity in let's say God forbid something bad happens, right? And you can't make your payments anymore and you've got to sell your house because you just can't afford the payments anymore. You've done everything you can and to avoid going into foreclosure, you're already behind, you sell the house. But because you have equity in the house, you're able to catch up on your debt, basically. Mm-hmm. And a lot of times, you know, people, it's kind of the fresh start, you know, it's just the way it works. And they have that equity and they have that nest egg. That's why homeownership is very powerful. And, you know, it's a huge part of our GDP. And it really contributes tremendously to an individual's overall wealth. Not necessarily your income every month, but your overall wealth. Two different things.
All right, tell me if this one is true. Housing supply is extremely low. In 2008, there was a huge oversupply of homes due to overbuilding. In 2025, there's a severe housing shortage, keeping prices elevated even with slower sales.
So we've done videos on this channel where you and I have kind of gone back and forth on overbuilding. There's been those topics, right? We're overbuilding. And, you know, I think you and I are on at least somewhat of an alignment that we're not overbuilding. Maybe in specific areas we might be building a little heavy, but at the end of the day, the builders got held with the bag in 2008, and they got hit hard.
Yeah, they got annihilated.
I mean, like most of them went out of business and they're not around. And houses just sat vacant for years, unfinished. And that was costing billions of dollars. This time, you know, things are a lot different. They're definitely a lot more cautious when they're building these houses. The programs are just run differently, and we'll do a whole video on that. But that's the difference between the two. We need more inventory. Even just because things are slow doesn't mean that we have come out of the inventory crisis.
I always say that, like my saying is, there's plenty of inventory, but very little affordable inventory. That's my saying. So I think that, you know, if you go to Zillow or you go to these real estate things, and there's plenty of houses for sale, but finding affordable homes is difficult.
Right. That's really what we need to be building. And the builders have recognized that, and they are beginning to build the more median priced homes or below median, which is what we really need right now.
Okay, next one, true or not true. Institutional investors play a bigger role. In 2008, individual homeowners were the primary buyers and sellers. In 2025, hedge fund companies and corporations own large portions of rental properties, keeping prices artificially high.
On
Homes.
purchases
Yeah.
in general?
Yeah. So do you think that in 2008, it was primarily, pretty much buyers and sellers, and maybe the mom and pop,
Yeah,
renters
so
and stuff like that?
Yeah, they have a couple doors.
But now there's some big corporation like Open Door and,
Well, I don't know if I'd use it as an example, but
well, but there's some people that come in and they buy a lot of houses.
yeah, but I don't think they're contributing much more than, I don't remember this. I mean, but it was below 20% of all sales
But do you
corporate.
think that's a true statement?
No.
Okay.
I don't think that's keeping. I don't think that because a corporation purchases a home to become a rental, I think that would affect more inventory because they're going to hold a lot longer.
I don't think the next one is true, but you tell me, and you guys tell me, comment below. The government is more prepared. In 2008, policymakers were slow to react, which is true.
Yeah.
In 2025, regulations and more perspective in preventing another full-scale crash, though that doesn't mean it can't happen. It can't happen. So do you think the government is more prepared to make sure that it does not happen again? You think they learned that lesson?
No. I think that from a regulatory standpoint, with Fannie Mae, Freddie Mac, CFPB, the Consumer Financial Protection Bureau, all these things were put into place after 2008 to protect the consumers. So I think from a regulatory standpoint, we're in a much better position, but I feel like saying that because the government doesn't react fast to pretty much anything, I don't think.
No.
So I think those stopgaps are in place right now, and I think those are what would help. But if something else off of left field, because I just don't think we could see a crash again due to the exact same reasons as we had in 2008.
No, I don't think so too. Well, that's what we're going to talk about next. Can this real estate crash happen again? So here's some notes that I did. A full-blown 2008 style collapse is unlikely because of stricter lending practices and low housing supply. Agree or disagree? Lending. 2008 crash was all about
Lending.
Yeah,
I don't see it at all happening for the exact same reasons that we had in 2008 from a lending standpoint.
All right, talk to me about this one. However, a market correction could happen, especially if high interest rates persist and demand weakens.
Correction and crash are two different things.
That's what I want to talk about. So basically, here's my philosophy on that. If rates hit 10%, real estate is screwed. I just think. I think that's psychological, that like now you're double digits interest rates, like
Yeah.
the late 80s, early 80s, I mean.
Right, and I mean, I know people make reference, and I know we've referenced it in the past too, back to the 80s and how much this, that, and the other costs, and
Yeah, but the houses were also $100,000.
less expensive. And yes, we made a lot less money, but the houses were much less expensive back then. Yeah.
What's the average mortgage payment now? Like $3,400, isn't it?
Yeah, I think so. Yeah, right around there. With the, for everything, not just more. So you have to be careful when you read those stats, because people say your mortgage payment is this, but you got to remember your mortgage payment is everything: property taxes, insurance, the whole shebang.
But like for me, I think $3,400, $4,000 a month, I think is crazy to pay that for a mortgage. But I know that's what the average mortgage is.
Well, yeah, but that's the way it is.
But that's the way it is. Like you said, remember we were talking about in the last video and we got a little disagreement. You said, well, $600,000 is an affordable house.
It is an affordable house.
Okay, and I don't agree that $600,000 is an affordable house. We finally came to the conclusion that maybe in some areas it's considered affordable.
Well, yeah, but if your median income is, $40,000 a year, then that is an extremely unaffordable house. If your median income is $190,000 a year, 200 some odd $1,000 a year, that's an affordable house.
So here's something that I wrote down that, I think that may be true in certain areas. Certain areas overheated, like Florida, Texas, and West Coast cities could see price drops, but nationwide the crash is less probable. So what I meant by that is, if there's a market correction, I don't think it's going to be national like it was in 2008. I think it's going to be in certain areas. I think Florida is vulnerable. I think Texas is vulnerable because we skyrocketed
Well, a lot of places skyrocketed,
but nothing like Florida and Texas.
Right. Well, this could go into a whole debate, but we'll save that for another video. But I think that we're vulnerable, but I don't think we're so vulnerable that we're gonna just have this massive crash. I think you'll see the signs on the wall before we have an actual crazy decline. But again, back to kind of what the comment was: correction or crash. Two different things. Correction.
2008 was a crash.
Yeah, 2008 was a flat-out crash. And then if you look at the graph has been going up ever since, equity-wise on your property. But a correction, I just don't want everybody to see, I look on Zillow, realtor.com, Redfin, whatever, and I see everybody's price reduction. I'll give you that. Price reductions are up, so that is a little bit concerning. However, what I'm seeing when I start pulling numbers, particularly because we've got a couple buyers right now, I start to see how everybody, I question, how did they come up with that number?
I'll tell you right now, a lot of realtors are trying to buy the listing by agreeing to the prices. Because I know some realtors will say, you know what, I'm not even going to take this listing. The home's not worth it. I'm not wasting my time. But some of them are like, they're so desperate. They're like, I'll take the listing and I'll list it. Some people are just waiting for that unicorn buyer, like, maybe the first 2 weeks this person will show up and be willing to pay for it because it's the perfect house.
Because my neighbor did it a year and a half ago or 2 years ago, or Joe down the street.
But that's what a lot of the reduction in prices are.
Right.
Because of things like that. But I think that we're still going, like I always said, like last year, the first 6 months, we're going to have a rough time.
It's going to be rough.
It's going to be rough. And now I'm kind of thinking maybe I was wrong. Not the first 6 months, maybe the first 9 months, or maybe the first year.
Yeah, I think the first 6 months, to be honest, is going to be the true tell.
Yeah.
I think that's going to be the tell as to how we're going to go in the economy, because we're only 55-ish days into the new presidency. So we have to see what happens, and it's kind of been gangbusters thus far. So we need to see what happens.
My numbers on the inspection side are up by almost 30% from last year.
Right.
For just this short period of time.
Exactly. And sales are up.
Yeah.
So this is where I go, okay, well, is it a small uptick? This is why you can't, we can look at these micro trends that go up and go down, but then you look over at the whole.
When is the busiest time? Until what, July it slows down?
Yeah, it starts slowing down in July, August.
July, August slows down right before the kids go back to school.
Yep. Yeah, everybody kind of wants everybody settled and done.
We did a survey, if with Trump being president, I gave 3 choices, and you guys could check it out. I gave a choice that he's going to help real estate, he's not going to make a difference, or he's going to hurt real estate. And 42% said he was going to hurt real estate. I'm just saying, I put it out there.
I'm just curious as to why. Like, that's really, because I want that. I think that would make
it's a survey that I put out.
Yeah, but I mean, I would love to know where their thoughts, because that would be a great video.
Well, I mean, I did.
Like, I think it would be a good video.
Yeah, it would be a great video, but that's what it is. More people think that, very few people think that he's going to help real estate. I think it was like 13%.
Mm-hmm.
A lot of people said that he's not going to make a difference, but the majority said that he's going to hurt real estate.
I'm super curious. If you know or you have an opinion on that, drop it in the comments, because I think if we can get enough of that data, that would be a great video, and those would be some good topics to debate too.
Yeah, and when you see my community posts, for surveys, it takes 2 seconds. Read the question and click on it. Anyways, that's today's video. Do me a favor, share this video, give it a thumbs up. And great, like always, consider subscribing. Check out this video right here. I picked it out just for you, and we'll talk to you in the next one.
See you on the next video. Thanks for watching.
Bye.